I called my primary dealer in Zurich this morning. This is a guy I've known for 15 years. He's Swiss, which means he usually has the emotional range of a pocket calculator. If the world was ending, he'd probably just adjust his tie and ask if you wanted a receipt. Usually, when I call him, he answers with a joke about the weather or a complaint about the traffic on the Bahnhofstrasse. Today, he didn't say hello, he didn't tell a joke, he just picked up the phone and said, "John, I can't book it." I paused, I looked at my screen, I said, "What do you mean you can't book it? I'm staring at the spot price right now, it's flashing $92.50, just lock it in." He laughed. It wasn't a happy laugh. It was the laugh of a man who is watching a building burn down while the fire department stands outside arguing about who has to pay the water bill. He said, "John, the screen is a ghost. The metal is gone. I have a 6-week wait for 1,000-ounce bars, and if you want coins, you better be willing to pay a premium that would make a loan shark blush. The price on your screen is for people who want to trade paper promises. If you want the metal, the price is good luck." Then he hung up. That click was the loudest sound I've heard in 20 years of trading this market. We know the game is rigged. You know it. I know it. We have spent years talking about the manipulation, the spoofing, the relentless smashing of the paper price every time silver tries to lift its head. But usually the riggers have the decency to hide the wires. Usually they operate in the shadows, using complex derivatives and high-frequency trading algorithms to paint the tape. But yesterday they didn't just pull the wires, they ripped the entire electrical panel off the wall, threw it in the middle of the trading floor, and dared you to touch it. Silver didn't just cross $90, it smashed through it like a runaway freight train hitting a wall of balsa wood. We hit a high of $95.77 in the early Asian session. Gold is sitting at 4,016. The physical market is screaming. The premiums are blowing out to levels that make absolutely no mathematical sense unless you understand that we are witnessing a complete failure of the delivery mechanism. And what did the exchange do? Did they celebrate the free market? Did they open a bottle of champagne for true price discovery? Did they issue a press release congratulating the longs for finally being right? No. They changed the physics of the casino. Exactly what happened is this. The CME just implemented a new dynamic margin system. They stopped using the traditional fixed dollar margin requirements where you knew exactly how much cash you needed to hold a contract, and they switched overnight to a percentage-based scaling model. That sounds boring, right? That sounds like an accountant moving a decimal point on a spreadsheet. That sounds like something you read in the fine print of a user agreement and ignore. It is not boring. It is a weapon. It means that from now on, as the price of silver goes up, the cost to hold a contract goes up automatically, instantly, and exponentially. There is no committee meeting, there is no press release, there is no lag time where we can squeeze the shorts before they adjust the rules. They just built a self-tightening noose around the neck of every long speculator in the market, and they did it exactly 48 hours after silver threatened to break the triple-digit barrier. I'm John OG, and I am running a campaign against the copycats, the scrapers, and the AI bots that are going to steal this script, voice it over with a robot, and try to sell you a scam crypto token in about 20 minutes. If you want the real analysis, the stuff that actually connects the plumbing to the policy, the stuff that keeps you safe when the floor drops out, do me a huge favor. Go to the comments right now and type OG John OG. It tells the algorithm that you're a human being who values the truth, it annoys the scammers, and it helps us keep this community alive. Win-win. Now stop scrolling, put your phone down on the table, because we need to talk about why this specific rule change isn't just about making trading expensive. It's about stopping a run on the vault. To understand why this matters, you have to go back 6 months. You have to understand the timeline that led us to this specific moment of panic. Remember where we were in the summer of 2025? Silver was fighting just to hold $50. The narrative was industrial slowdown. The media told you solar demand was peaking. They told you the recession would crush base metals. They told you that the AI boom was the only game in town and that commodities were dead money. We told you that was a lie. We told you that the bond market was breaking, that the BRICS nations were moving to hard collateral, and that the paper price was just a suggestion. We tracked the vault withdrawals when nobody else was watching. We showed you the EFP, exchange for physical data that proved the banks were moving massive short positions to London to hide them from US regulators. Fast forward to today. Tuesday, January 20th, 2026. We aren't fighting for $50. We are fighting for $100, and the system is panicking. You can see it in the data. You can see it in the desperation of this rule change. They realized that the old way of smashing the price, the 3 a.m. margin hike, was too slow. It was too obvious. Every time they did it, we called them out. Every time they hiked margins manually, it became a headline on this channel. CME hikes margins to stop silver. It looked like manipulation because it was manipulation. So what did they do? They automated the manipulation. They changed the code so that the margin hike happens in real time. Price goes up 10%, your margin requirement goes up. Price goes up 20%, your margin requirement goes up harder. They have turned the market into a treadmill that speeds up the faster you try to run. This is the soft cap. This is how they try to kill the rally without looking like they killed the rally. But here's the part they didn't calculate. Here's the part that makes this the most dangerous setup I have ever seen in my entire career. The physical market doesn't care about their margin rules. While the paper traders are getting margin called by an algorithm in Chicago, the physical buyers in Shanghai and Mumbai, in the private vaults of Texas, and in the sovereign wealth funds of the Middle East are simply taking the metal off the table. We are seeing a divergence that shouldn't exist. Paper silver is getting expensive to hold, but real silver is becoming impossible to find. Do you understand what that means? It means the casino is trying to close the doors while the chips are still on the table. They are trying to change the rules of blackjack after you've already been dealt 21. Let's dig into the plumbing, because if you don't understand the mechanics, you are going to get washed out by the volatility. Part 2. The mechanics in history. Let's walk through exactly how a margin requirement works, because 90% of the people screaming about this on Twitter don't actually understand the engine room of the futures market. When you buy a futures contract on the COMEX, you aren't buying 5,000 ounces of silver. You are renting exposure to 5,000 ounces of silver. You are placing a bet on the direction of the price. You put down a deposit. That's the initial margin. Let's say in the old days, last week, it was a fixed number, maybe $18,000 to control $400,000 worth of silver. That's leverage. That's the juice. That's why hedge funds play the game. That's why speculators love it. You put down 5% or 10% of the value, and you get 100% of the gains. If the price moves against you, you have to top up that account. That's a margin call. But here's the trick. In the old system, if silver ripped from $50 to $90, your initial margin requirement stayed the same until the exchange held a meeting, voted to raise it, and issued a notice that went into effect at the close of business the next day. That lag time, that gap between the price explosion and the rule change, was the squeeze zone. That was the window where momentum traders could pile in, use massive leverage, and drive the price vertical before the exchange could stop them. That is how we got the run in 1980. That is how we got the run in 2011. The exchange was always one step behind the market. The CME just closed that window. They welded it shut. With dynamic percentage-based margins, the margin is calculated as a floating percentage of the notional value of the contract. Let's do the math. Silver is $95 today. One contract is 5,000 ounces. That's a notional value of $475,000. If the margin is set at, say, 15% dynamically, you need $71,250 just to sit at the table. Now imagine silver goes to $120 tomorrow. The contract value jumps to $600,000. Your margin requirement instantly jumps to $90,000. You didn't buy more silver. You didn't change your position. You didn't do anything but be right. But suddenly your broker is calling you demanding another $20,000 just to keep the trade open. Do you see the genius of this trap? It turns a bull market into a liquidity drain. The higher the price goes, the more cash is sucked out of the long side of the market. It acts like a gravity well. It forces speculators to sell just to free up cash. It mechanically dampens the price. It is designed to prevent a parabolic spike. We have seen this movie before. We know how the script ends for the people who don't have staying power. In 1980, the Hunt brothers tried to corner the market. Everyone knows that story. They bought physical and they bought futures. They bought so much that the exchange panicked. What did the COMEX do? They passed Silver Rule 7. They literally changed the rules in the middle of the game. They said liquidation only. That means you can sell, but you cannot buy. Imagine going to a grocery store and being told you can return the milk you bought yesterday, but you cannot buy a new carton. What happens to the price of milk in that store? It crashes. They forced the price down from $50 to $10 in weeks. They bankrupted the Hunts. They saved the shorts. In 2011, silver touched $49. The CME hiked margins 5 times in 9 days. 5 times. They didn't even pretend it was about safety. They bludgeoned the price to death with a hammer labeled risk management. They hiked it on Monday, hiked it on Wednesday, hiked it on Friday. By the end of the week, nobody could afford to hold a long position, but this time is different. In 1980 and 2011, they used a hammer. In 2026, they have installed a thermostat. They want you to believe this is just modernization. They want you to believe this is just efficiency. It is not efficiency. It is fear. Why are they afraid? Why go to this dynamic model now? Because unlike 1980 and unlike 2011, the inventory isn't there. In 2011, the COMEX warehouses were relatively healthy. There was metal to be moved. The eligible category was full. The registered category had tens of millions of ounces. Today, look at the eligible versus registered category breakdown. I've been tracking this every single night for the last 3 years. The registered category, the stuff that is actually available to be delivered right now against a warrant, is razor thin. We have seen nearly 50 million ounces leave the vaults in the last month alone. That is not normal flow. That is a run. If you adjust for inflation and the size of the global money supply, the available physical silver on the COMEX is at a historic low. And this leads us to the logic trap. I want you to answer a question that the mainstream media refuses to ask. I want you to answer a question that CNBC will never ask because their advertisers won't let them. If silver is just a barbarous relic, if it's just a volatile industrial commodity, if the price is too high at 95, why is China quietly paying a premium over spot to import it? Why are the solar gigafactories in India signing offtake agreements directly with miners, bypassing the exchange entirely? Why did the BRICS nations explicitly list silver as a strategic Tier 1 asset in their new settlement framework? If the price is a bubble, why is the smart money securing the physical metal while the paper market tries to make it illegal to hold it? The CME isn't protecting the market from a bubble. They are protecting the shorts from a default. Because if the price goes to $150, the short side of the market, the bullion banks, the swap dealers, the entities that have sold paper silver they do not have, they don't just lose money. They lose existence. They face an existential solvency crisis. Let me explain backwardation because this is the smoking gun. Normally, silver in the future costs more than silver today. Why? Because you have to pay for storage, insurance, and the interest on the money you tied up. That's called contango. It's a healthy market. Right now, we are in backwardation. Silver today costs more than silver next month. Why would you pay more for something now than later? Because you don't believe it will be there later. It's like water in a desert. If you have a bottle of water and I'm dying of thirst, I will pay you $100 for it right now. I won't pay you $100 for a promise of water next week because I might be dead by then. Backwardation is the market screaming that there is a shortage of immediate deliverable bars. And the CME knows this. They see the lease rates spiking. They see the EFP blowing out. They know that if they don't slow down the paper price, the arbitrageurs will drain every last ounce out of the vault and the exchange will fail. So they changed the rules. They built a wall. But here is the problem with walls. They work fine against people. They don't work so well against a tsunami. Now we need to zoom out. Because if you think this is just about a few traders in Chicago arguing over a decimal point, or a few silver stackers getting excited about a coin show, you are missing the forest for the burning trees. Silver is not moving in a vacuum. Silver is the pressure release valve for a global financial system that is fundamentally broken. Look at the bond market. While everyone was watching the silver chart, did you see what happened in Japan? The JGB, Japanese government bond yields, are pushing levels we haven't seen in decades. The 30-year yield in Japan is surging to 3.5%. Why does that matter to you in Ohio or London or Sydney? Because Japan is the anchor. Japan has been the source of cheap money for the entire world for 30 years. The carry trade, borrowing in yen at 0% interest to buy dollars, to buy stocks, to buy bonds, is the engine of global liquidity. When Japan's rates rise, that engine stops. The carry trade unwinds. Billions of dollars of liquidity are being sucked out of the global system to pay back those yen loans. When the carry trade unwinds, liquidity evaporates. Things break. And when things break in the sovereign debt market, capital has two choices. It can stay in the burning theater and hope the fire extinguishers work. That's the stock market. That's the corporate bond market. It can run for the fire exit. Gold at $4,600 is the fire exit. Silver at $95 is the fire exit. The dynamic margin change at the CME is the theater management trying to lock the fire exit doors because too many people are trying to leave at once. They are trying to force you to stay in the dollar. They are trying to force you to stay in treasuries. They need you to hold the debt because they have too much of it to sell. But the end of the dollar thesis isn't a thesis anymore. It's a headline. Look at the news out of South America. You saw the reports. U.S. forces allegedly detained Nicolas Maduro in Venezuela. Whatever your politics, look at the financial reality of that event. Venezuela sits on the largest oil reserves in the world. For years, that oil was offline. Now, the control has changed. But here is the twist. China isn't walking away. China has been building parallel payment rails, using gold, using the digital yuan, using silver-backed notes to secure energy resources without using the US dollar. The seizure of Maduro might look like a win for the dollar, but it's actually an accelerant for the alternative system. It tells every other country in the world, if you cross the US, they will come for you. So you better have a financial system that doesn't rely on SWIFT. We are seeing reports of trade settlement outside the SWIFT system hitting record highs. We are seeing central banks hoarding gold at a pace that makes 1960 look like a joke. And silver? Silver is the poor man's gold, but it is also the smart man's uranium. It is the only monetary asset that is also disappearing into industrial production. Every solar panel is a silver tomb. That silver isn't coming back. It's gone. It's pasted onto a wafer and put on a roof for 20 years. Every EV is a silver sinkhole. Every AI data center, and yes, the AI boom is a massive energy and hardware story, requires silver for high-efficiency contacts. You cannot have the AI revolution without silver. So we have a situation where the monetary demand for silver is exploding because the bond market is breaking. The industrial demand for silver is exploding because of the green energy and AI transitions. The supply is flatlining because we haven't built new mines in 10 years. We are running a monetary deficit, printing trillions, and a physical deficit, consuming more silver than we mine, at the same time. It is the perfect storm, and that is why the CME move is so terrifying. It signals that they know they have lost control of the price. If they had control, they wouldn't need to change the rules. You don't change the rules of the game when you are winning. You change the rules when you are losing. They are losing, but do not think for a second that they will go down quietly. This rule change creates a two-tier market. Tier 1, the paper market. This is the price you see on your phone. It will be managed, it will be volatile, it will be whipped around by margin calls and algorithmic slams. They will try to keep it under $100 for as long as possible to discourage you. Tier 2, the street price. This is what you pay to actually get metal in your hand. We are already seeing the spread widen. I heard from a dealer this morning, a big one, not a guy in a basement, who told me that for volume orders, he is quoting spot plus $12, spot plus $15. Why? Because he can't replace his inventory at the spot price. If the paper price is $95, but you can't buy metal for less than $110, what is the real price of silver? It's $110. The paper market is becoming a fiction, and the CME just admitted it by trying to rig the game. This brings us to the most disturbing part of the macro picture, the Fed criminal probe story. You saw the headlines. Subpoenas served to the Federal Reserve regarding a renovation project. Now maybe it's nothing. Maybe it's just administrative oversight. But the market doesn't care about the truth. It cares about the perception of stability. When the Department of Justice is investigating the central bank, confidence in the currency erodes. When confidence erodes, velocity picks up. People spend dollars faster because they trust them less. That is inflation, not the supply chain kind, the monetary kind, the kind that destroys empires. Silver is the canary in the coal mine, and the canary just started singing heavy metal. Part 4. The close. So, where does this leave us? It leaves us in the most dangerous phase of the bull market, the volatility washout phase. They are going to use these new dynamic margins to try and break your will. They want to see silver whip $10 in a day. They want you to wake up, check your phone, see a 15% drop, and panic. They want you to get margin called. They want you to panic sell your physical stack because you see a red candle on the screen. Do not give them the satisfaction. If you are playing with leverage on the COMEX right now, you are dancing in a minefield where the enemy controls the detonator. They can change the margin to 20%, 30%, 50% whenever they want. They can liquidate you in a microsecond. They can change the rules so that you can only sell, not buy. But if you hold the physical metal, if you hold the real asset, they can't margin call a monster box. They can't change the rules on a bar buried in your backyard. They can't hike the maintenance requirement on a coin sitting in your safe. That is your power. That is your sovereignty. This fight is not over. $95 is not the top. $100 is not the top. When the bond market truly cracks, when the Japan unwind hits the U.S. Treasury market, we are going to see a repricing that will make $95 look cheap. We are going to see a repricing that will make the 1980 high look like a warm-up. But the path from here to there is going to be violent. You need to be prepared. You need to be informed. And you need to be connected to a community that sees through the fog. That is why I created the private group. We are tracking the vault withdrawals daily. We are tracking the EFP data that shows the banks moving positions to London to hide them. We are tracking the specific delivery notices that show which banks are desperate for metal. Join the WhatsApp channel. Link is in the description. I post the charts there that YouTube won't let me show because they are too controversial. I post the voice notes when the smash hits, explaining exactly why it's happening so you don't panic. Join the membership if you want the deep dive research reports on the mining stocks that are positioned to benefit from this, because the miners have not even started to price in $95 silver yet. The miners are lagging, and that is the opportunity of a lifetime. And one final warning, the next move from the establishment won't be polite. It won't be a rule change, it will be an outage. You will try to log into your brokerage account, and it will say system maintenance. You will try to check the price, and the feed will be down. You will try to buy from a dealer, and their website will say inventory update in progress. It will be a cyber attack. It will be a force majeure. It will be a glitch. When they can't control the price with margins, they will control the access. Get your house in order. Get your metal in your possession. And do not trust the screen. The screen is a lie. The metal is the truth. You didn't think I was done, did you? The YouTube algorithm hates videos over 30 minutes, but for the real ones who are still watching, let's go deeper. Let's talk about the Venezuela blackout story and what it really means for the silver market. We mentioned the capture of Maduro. But did you see the report about the ghost flights? During the transition of power, during the chaos, there were reports of cargo planes leaving Caracas, not heading to Miami, heading to the east. What was on those planes? Venezuela has gold, everyone knows that, but Venezuela also has silver, and in a regime change, the first thing that moves is the portable wealth. If that metal hits the open market, you might see a temporary dip, a liquidation event. But if that metal goes straight into the vaults of a strategic partner, say a country that rhymes with Mina, then that supply never hits the market. It vanishes. It gets absorbed. This is the black hole theory of the silver market. For years, we assumed that all silver mined eventually hits the market. But what if it doesn't? What if the strategic accumulation by sovereign states is happening off-market? This brings us back to the COMEX. I want to explain EFP again because I got 1,000 comments asking about it. Exchange for physical. When a bank is short silver on the COMEX and the price rises, they have two choices. Deliver the metal. They don't have it. Buy back the contract. This drives the price up. But there is a third door, the magic door. They can use an EFP transaction to swap their COMEX futures position for a London OTC over-the-counter position. They tell the COMEX, hey, don't worry about this short position. We are settling it with physical metal in London. The COMEX says, okay, great, position closed. But did they actually deliver the metal in London? We don't know. The London market is opaque. It's a gentleman's club. There is no daily reporting of vault holdings like there is in New York. So the banks use EFP to flush their toxic short positions out of the visible US market and hide them in the dark London market. This works fine as long as London has metal. But we are hearing reports, rumors, but credible ones, that the London vaults are just as empty as the New York ones. If London fails, the EFP mechanism breaks. The magic door gets bricked up, and when that happens, the banks are trapped in a room with a hungry tiger, and there is no exit. That is why I say $95 is cheap. That is why I say $100 is just the beginning. Because when the EFP game stops, the price has to go to a level that forces you, yes, you watching this, to sell your grandmother's silverware. They will need to scour the planet for every ounce of scrap silver to meet the delivery demands, and they will have to pay you for it. So what is your price? Is it $100? Is it $200? Or is it not for sale? Think about that. And while you're thinking about it, look at the mining stocks. The GDX, Gold Miners ETF, and SIL, Silver Miners ETF, are starting to wake up, but they are still trading like silver is $30. Why? Because the generalist investors, the pension funds, the endowments, they haven't bought yet. They are scared. They have been burned before. But when silver holds $90, when it holds $100, the earnings of these mining companies will go ballistic. We are talking about free cash flow yields of 20%, 30%. You cannot ignore a company making that much money. The generalists will come. They will panic buy the miners just like the public is panic buying the metal. And that is the second leg of this bull market, the equity catch-up. If you are positioned in the right companies, the ones with real reserves, good management, and no political risk, avoid mines in countries that might nationalize them, you are sitting on a powder keg. I cover specific names in the membership area. I can't name them here because of compliance, but you know where to look. We are in the end game, folks. The margin hikes, the subpoenas, the blackouts, the shortages. It's all part of the same picture. The fiat system is hyperventilating. It's gasping for air. Silver is the oxygen tank, and they just realize the tank is empty. Stay safe, stay stacked, and for the last time, OG John OG.